Hi, hello, namaste, hearty, welcome to yet another interesting iLead Tax Talks. Thank you very much for joining us today. I hope I didn't scare you. So glad you joined us today, and I'll be very happy if both husband and wife, if you are married, you're watching this together. I'll be really very happy. We love to see couple planning their taxes together. That really inspires me that we are contributing to building families also. Well, if you just filed your tax return, whether you did it yourself through iLead, used TurboTax, or paid a local CPA, congratulations. You crossed the April 15th deadline. But here is what nobody is telling you after you filed your taxes. See, April 15th is not the finish line. Actually, it is the starting line. Starting line for your 2026 tax situation. So, today we are going to talk about something that most Indians in the USA never think about after tax season. What happens next? What do you do now in April, May, June? That will either save you thousands of dollars by December or cost you thousands of dollars by next year. Quick question here. Type yes if you just filed your 2025 tax return in the last few weeks. Okay. I want to know how many of you are in that post filing season mindset. People keep sending me, escalation emails after April 10th. Nanda, it's been 48 hours, that, this, and all. But as I keep telling you, even in my earlier videos, my priority has always been on the clients that plan the taxes. Not that I disrespect people who are just filing it. We do a massive number by God's grace and the love of our clients and hard work of our team members. But I have huge love and respect for those who plan their taxes. यानी उनसे बात करते रहते हैं, उनका नाम भी माइंड में रहता है. So it becomes easy for me, and I have clients since 2004 who are still filing with me. Well, this session is for you. So whether you are on H1B, whether you are on L1, green card, or US citizen, whether you are a software engineer, a doctor, a small business owner, or someone with investments back in India, if you earn good money and you are not doing tax planning, you are literally donating extra money to the IRS every single year. And the scary part, you will never get a bill for it. The IRS will not send you a letter saying, hey, you overpaid, $15,000. It will just quietly happen year after year. Well, for those who are watching me for the very first time, my name is Nanda Kumar KV. And at iLead Tax LLC, we have been working with Indian professionals in the USA for over 22 years. And what I'm about to share with you today is not textbook theory, though I'm a Chief Education Officer at iLead Tax Academy in India. Still, this is what we see in real client situations week after week. So I thought I'll make a detailed video for you. This, I'm sure it's going to help my peers in the industry. But I'll be very happy, if it is helping the clients. Okay, so grab a notebook, a pen, or take screenshots wherever that is needed, and let's get into it. Yeah, fine. Foremost, let's understand what's the difference between filing and then planning. Let me start with something fundamental because I have seen confusion about this even among very educated professionals. Tax filing and tax planning are not the same thing. They are completely different activities with completely different purposes. So you got to understand that first. See, think about it this way. Imagine you are driving a car. Tax filing is like looking in your rear view mirror. Rear view mirror. It shows you where you have been, what happened last year, how much you earned, what you spent, what you owe. You cannot change, what is already behind you, right? In life also. Tax planning, that is your GPS. It is figuring out the best route to your destination. So before you start driving, it helps you avoid traffic, it helps you take shortcuts, it helps you arrive faster and pay less in tolls along the way. Let me give you a real world example. Priya is a software engineer at Google in the Bay Area. She earns some $350,000 a year. She filed her taxes in March, paid some $85,000 in federal and state taxes, and moved on. Her CPA just did the filing. Then her colleague Rajan, same income, same company, same stock options, paid 65,000 only in taxes. Same year, same income. $20,000 difference. What did Rajan do differently? He did tax planning. Rajan did tax planning. Anybody by name Priya here, please don't get offended, okay? Rajan maxed out his 401k, he contributed to an HSA, he timed his RSU vesting strategically, he used the backdoor Roth, he spoke to a planning focused advisor, and it just went through. See, be honest, how many of you have ever had a dedicated tax planning conversation with your CPA or your enrolled agent? Not just a filing conversation, a planning conversation. I'm guessing, a very few. Anytime, I talk to my clients also, hey, why you haven't thought of this tax planning? Or why have you thought of this tax planning now? No, Nanda, I felt I am paying more in taxes. Felt. I realized. Or they're transferring money from India to USA, USA to India, making some strategic decision. Daily tax tips are helping, these videos are helping. So I thought, I'll schedule a session. Now, since when are you in US? From more than 10 years. Have you done a tax planning session? No. How were you filing taxes? Online or through some company? Did they connect with you for planning your taxes? No. How many companies call you for filing during the tax season? Huh? Hundreds, hundreds, right? But how many companies call you for planning? Few, or maybe iLead. That gap between filing and planning is exactly where thousands of dollars disappear every single year. Tax preparation tells you the numbers, but tax planning tells you what to do with those numbers before the IRS takes its share. And that is the mission of today's session. Now, see, the biggest mistake that I see after 22 years, in practice. See, in the 22 years of working with Indian professionals, even corporate companies who have recommended me, thanks to them, I encourage, these corporate companies to conduct, a free tax planning webinar at least, in your company. We are not selling your people anything. If they are interested, they can go to some other tax planning service provider also. But how many people approach you to give the tax planning awareness to your employees? And it's a free session. We don't charge you or the employee anything for attending a tax planning webinar. So please try to recommend us in your company to see if we can do a half yearly, tax planning awareness meet. and I'll be happy to help you. That's my email address, asknanda@ileadtax.com. Write to me. I'll be happy to help you. So, in over these 22 years of working with Indian professionals, whether H1B, green card holders, tech workers, doctors, business owners, I want to tell you the single biggest mistake I noticed. It is not fraud, it is not errors on the return, it is not bad investment. The single biggest mistake is no planning. No planning. People earn very well, they file diligently, sometimes they even use a big four firm. And yet, year after year, they overpay by thousands of dollars, not because they did anything wrong, but because nobody sat down with them proactively and said, here is what you should be doing, before December 31st. And by the time you realize this, it is usually, April 14th, the day before the deadline. And at that point, your options are almost zero. I mean, I see, clients telling some of our staff members, I'll pay you double, I'll pay you triple for whatever invoice, you have sent me. Please help me reduce this. I mean, jadoo ki chadi nahi hai abhi. There's no magic wind, in our hand. And any proper licensed CPA or a EA will not claim any false adjustments, credits, deductions, exemptions on your tax return because he cares for you. She cares for you. And they are not running, a window shopping business. That tax filing mein shutter kholo and tax filing ke baad shutter band karo. No. They want a perpetual existence. Just like iLead. Work with those kind of people. Are you able to find that professional in the Federal Directory of Tax Professionals? I mean, it appears, very silly when clients send an email for $10, $20 discount. Anyways, see, three things happen when you do not plan. Number one, overpaying taxes. Overpaying taxes. See, you are paying at the highest possible rate with no optimization. Every dollar of income gets taxed at your marginal rate, which could be 32%, 35%, even 37% federal. Again, state taxes on top if you are not residing in a tax free state. I had a client, a doctor in Texas, earning like more than half a million, say 600,000 a year, no planning. She was paying approximately 200,000 in federal taxes. We identified $40,000 in legitimate legal savings through retirement planning, early restructuring, and then expenses optimization. She had been overpaying, for the last 5 years. That is $200,000, in extra taxes over 5 years. Money she will never get back. Number two, missing deductions. There are deductions that expire if you do not claim during the tax year. You cannot go back after December 31st and say, oh, wait, let me make that retirement contribution now. The money has to be in the account by December 31st. Number three, unexpected penalties. See, the IRS changes underpayment penalties. IRS charges underpayment penalties. You see that line below amount you owe, एक छोटा line रहता है 1040 में, estimated tax penalty. People don't even see that. Then when they schedule a call, then they realize, Arey Nandaji, I didn't notice this. Nothing wrong. I'm just telling you. Understand your tax return. आपका है भाई वो. हम तो हजारों रिटर्न बनाते हैं, आपका तो एक ही रिटर्न है. ध्यान से देखिएगा. साल में एक बार भरते हो आप टैक्स. The IRS charges underpayment penalties. If you owe more than $1,000 at tax time and you did not pay enough throughout the year through withholding or estimated payments, you will get hit with a penalty. Right now, that penalty rate is approximately 8% annualized. Not huge on its own, but it adds up and it is 100% avoidable. The good news is it is 100% avoidable. Has anyone here ever gotten an IRS notice about underpayment penalties? Answer yourself. You will be surprised, how many people have. Now, coming to 2026, 2026 is not a normal tax year. Now, I want to talk about something that is very specific to 2026 because this is not a normal tax year. We are in the middle of the most significant tax law change since the Tax Cuts and Jobs Act of 2017. And most taxpayers, including most CPAs or enrolled agents, are not fully prepared for what is coming. If you are watching this as a replay, please verify these, with your tax preparer or tax advisor. Legislation moves fast, but here is what you need to know. First, the salt deduction cap. For years, high earners in New York, California, New Jersey, Illinois were limited to $10,000 cap on salt, on state and local income tax deductions. If you see your past income tax returns, you will be able to understand that. Now, that was brutal, really brutal. So, if you were paying $50,000 in state income taxes and property taxes, you could only deduct $10,000. The new legislation significantly raises this cap, and if you live in a high tax state, this could be one of the biggest individual tax changes in years. So, I encourage you to talk to us or to your tax planner if there is any about how to maximize this. I'll give you an example here. One of our clients, Amit, he lives in New Jersey, earns $500,500, pays some $45,000 in state income tax, plus $15,000 in property tax. Total some $60,000 in salt. Now, under the old rule, he could only deduct $10,000. But under the new rules, he can deduct far more. That difference could mean $10,000 to $15,000 in additional federal tax savings in just 1 year. The second thing is bonus depreciation. Bonus depreciation is coming back at 100%. Actually, came back. For my S Corporation and LLC business owners, my clients, this is huge. If you buy a qualifying business asset, equipment, machinery, certain improvements, you can fully deduct the cost in just 1 year, instead of depreciating it over years, and that can eliminate tens of thousands in taxable income immediately. Third, the new deduction for tips and then overtime pay. There are proposed new above the line deductions here, but these come with eligibility rules, income phase outs, and then industry definitions. So do not assume that everyone qualifies. Okay, sometimes if your income is too high, you may not qualify for certain deductions. So if you or your family members receive tips or overtime pay, get this analyzed specifically for your situation. Don't just confine to W4 alone. W4 is not planning, that is compliance. Every month, जैसे इंडिया में आपको TDS डिडक्ट होता था, यहाँ पे भी आपको फेडरल, स्टेट, लोकल विथहोल्डिंग्स होते हैं. वो फॉर्म आपको ठीक से भरना है. You have to fill your W4 form properly. Sometimes client tells me that नहीं नंदा जी, इंडिया में मैं सेपरेट, मेरे वाइफ सेपरेट फाइल करते थे, तो I put single in the W4. And at the end, they were like happy that, oh, we are getting refund. We are getting more refund than my friends. No, your friend planned tax properly so that he is getting more take home pay every month. Are you getting it? More take home pay every month. Refund is an interest free loan that you are giving to IRS. It's an interest free loan. $1,000-$2,000 refund आ गया, okay. But $10,000, $20,000 का refund. Fourth, auto loan interest deduction. A new potential deduction for interest paid on car loans with important caveats about vehicle qualification. So, you need more information on that, you can contact us. You see our contact details below or send an email to me. Fifth is several valuable tax credits will not be there after 2025. They are kind of sunsetting. So if you have been relying on certain credits, they may disappear or be significantly reduced from 2026. You need to act now, to capture any remaining value. And I'm not sure, if your CPA or EA ever mentioned, any of these changes when you filed your 2025 tax return, or even after filing your 2025 tax return. Some of them, they feel very few of them, they feel irritated to read the tax tips. They see the tax tip email. What is this? Remove me from your spamming email. Somebody replied me. I told my team, please remove this person. Please remove this person and make note of this person. In case he is asking us tomorrow how to reduce taxes, because what happens is when you are going to a doctor cannot tell you, in this fearful and wonderful body that God has made for this mankind, unless we tell the doctor exactly, कहाँ पे आपको problem है, doctor is not God to identify the problem. So there may be so many changes, that's happening in your life. That's what I say, review your iLead. इनकम में चेंजेस हो सकते हैं, लाइबिलिटीज में चेंजेस हो सकते हैं, एक्सपेंसेस में चेंजेस हो सकते हैं, एसेट्स में चेंज हो सकते हैं, ड्रीम्स there may be a new dream, new desire. iLead, income, liabilities, expenses, assets and dreams. When you review your iLead, there may be so many questions that is coming your way. I had one of my clients, who had a preterm baby. They spent so much on the baby and also on the mother. You know how expensive it is. I mean, just read through. जरूरी नहीं है कि सब दुख दर्द आप ही झेल रहे हो जिंदगी में. You may come across, somebody in your network. You may not be able to help them, with money. अरे, I was reading through this tax tip यार. ये नंदा कुछ भिजाया था आज. तो मेरे ख्याल में आया. You came to my mind. I thought you should give it a read. If you have any questions, consult this fella. Simple. Or use, AI tools. आप सब लोग तो majority are IT professionals only. Leverage AI tools. Ask. At least you will have some awareness. Don't hate knowledge. Unnecessary फालतू का reels. Sometimes, we will be watching. Straining our eyes. Not getting sleep. Tax tips. This information. It is good for you. कितना देर देखोगे एक वीडियो? I guess, most of you heard nothing about this particular slide alone. Well, I'm not boasting about us. I'm just telling you the reality. When I talk to the clients, and some of them, they really go through some challenges. We may not, support every client or every friend financially, but at least we can tell them. See, in business, increasing revenue is one thing, and the other thing is reducing the expenditure. Both are very important, increasing the revenue and then reducing the expenditure. So just by following a tax tip, you may reduce your tax liability, which is also savings for you. Elders say, right? A rupee saved is a rupee earned. Now, who needs tax planning right now? Let me be very direct with you. See, if you fall into any of the following categories, even one of them, you are almost certainly leaving, thousands of dollars on the table every single year. And the frustrating part is you may never even know about it. Now, let me take you one by one. Group 1, W2 employees, earning 200,000 to 800,000, let's say. I know what you're thinking. I'm just a W2 employee. What can I do? My employer handles my taxes. Wrong. Wrong. Some of the biggest planning opportunities we find are for high income W2 employees, like 401k strategy, HSA, SALT planning, backdoor Roth IRA, deferred compensation, starting a new business in wife name, or something like that. Hiring kids in your business. There's a lot you can do, but only if you plan. Group 2, tech employees with RSUs and then ESPP. If you are in big tech, Google, Meta, Amazon, Microsoft, Apple, and you have RSUs vesting, listen carefully. Every single vesting event is a tax event. Your employer withholds at a flat 22%, but if your total income is 400,000 or 500,000 or more, your marginal rate might be 35% or 37%. That gap between 22% withholdings and then 37% owing comes out of your pocket on April 15th with penalties. Example, Vikram works at Meta. 180,000 base salary, 120,000 in RSUs, vest in 2026, let's say. His employer withholds 22% on the RSU income, about some 26,400, but his actual tax rate on that income is 35%. He owes $42,000, gap 15,600, plus underpayment penalty. And he is blindsided when it comes to tax filing. Nandaji. Group 3, LLC and then S Corp owners. If you are a consultant, freelancer, or small business owner, entity structure is one of the biggest levers you have. An S Corp election done right can save you anywhere from $15,000 to $20,000 per year in self-employment taxes alone. But most people, either do not know this or they set up the S corporation incorrectly. Arey, iLead mein itna महंगा hai. No, let me do online. Why people study CPA or EA then? If everything was online, taking too much salary or not paying themselves at all. Are you going to farm your business every year? एक बार करते हो आप, कितना एक्स्ट्रा पे करोगे? 500 पे करोगे? किसी भी कंसल्टेंट को, आई एम नॉट टेलिंग अबाउट iLead. From your online, are you paying more than $500, more than $1,000 in a year? Even if you are making like 100,000, 200,000, what is $1,000? Group 4. Choose your tax advisor wisely. They say customer is the king, but every king needs a wise minister. हम यही पढ़े हैं यार, हम यही करते हैं. यही करते हैं हम. So talk to an expert. Group 4. NRIs with Indian investments. Now, thank you for making my PFIC videos viral. Some of them started asking me, am I partnered with IRS? I'm scaring taxpayers. No. I love my clients. I care for them. And I want them to know the rules. Even if you choose to break them, know the rules. क्या है? पहले क्या है? Rule क्या है? So, Indian mutual funds, NRE, NRO accounts, PPF, EPF, real estate back in India. If you have any of this, you have cross-border tax obligations. And most general CPAs or EAs are not equipped to handle these correctly. Watch my PFIC videos and you can watch me for that if you found, related content like that. I mean, if any videos came up, after I made videos, I'm not talking about them. But before I made, if you found something, you should know how much we care for you. That kind of advice to set up a call like that also, PFIC cases $500 to $1,000. That's the fees people charge just for the consultation. Try checking that. ये आपको फुकट में मिल रहा है, मुफ्त में मिल रहा है. This advice. Please take time to watch this. If you are not able to watch this video completely, please watch it in bits and pieces. Oh, okay, 30 minutes okay. Fine, I'll stop here. I'll again watch tomorrow. It's interesting. Let me just go around, this 30 minutes what this fellow was speaking. Review. Group 5. H1B, L1, H4 EAD, OPT, green card holders. See, visa holders face unique rules around tax residency, treaty positions, and foreign account reporting. Getting this wrong can jeopardize not just your finances, but sometimes even your immigration status. I'm not scaring you, I'm just telling you the law. Tax clearance certificate, it's needed. Particularly if there are tax compliance issues that surface during green card or citizenship applications. Which of these groups are you in? or multiple numbers if you fit, more than one category. Contact us. Contact us. We'll be happy to help you. Now, I'm going to do, something that most professionals never do on YouTube. Okay. I'm going to show you some real numbers, not hypothetical, not theoretical. These are the kind of outcomes, that happen when real clients make the shift from filing to planning. Okay. From filing to planning. Three stories. Okay. Three very different situations, and combined, they represent what is possible for people watching me right now. Okay. Now, story one, $300,000 W2 employee, software engineer, no business, no rental property, just a paycheck, $12,000 saved. We are going to go line by line, through exactly how. Then story two, an S corporation owner with $250,000 in net business income, $18,000 saved. $18,000 saved. Enough to fully fund a retirement account. Then story three. And this is one of the most important for Indians in the USA, an NRI holding Indian mutual funds. This person was facing a potential effective tax rate exceeding 50% on their investment gains, not because they did anything wrong, because they did not knew about the PFIC rules. So if you have Indian mutual funds, whether SBI, Blue Chip, HDFC Top 100, Parak Parik, or any other mutual fund, please pay very close attention to what is coming next. This may be the most important thing you're hearing today. Yeah, let's go one by one. Yeah, are you excited? Am I doing good? Let me know how you feel about these videos. Let me know how you feel about these videos, because your feedback, even if you're not signing up for our services, your feedback will motivate me every week. I mean, ऐसा video बनाना भी जरा मुश्किल है. You can check out, with other CPAs or EAs in the industry. Not that I'm a teacher, but I love educating. Whether it's my students, my clients, my team, I love educating on what I know. So please let me know your feedback. It'll make me feel happy, and it'll also motivate me. Yeah. Now, case study one, the 300K W2 employee. Yeah. So meet Rajesh. Rajesh ji, namaste. Okay. He's a software engineer at a major tech company in Seattle, Washington. $300,000 W2 income. No side business, no rental, just his salary and maybe some small RSU vests. Before planning, Rajesh was paying $75,000 in federal income taxes. That's a 25% effective rate, which sounds right to most people. They accept it and move on. Now, after planning, same income, same year, Rajesh saves $12,000 in taxes. Legally. Chill. Legally. Completely above the board. Okay. Now, here is exactly how. Step 1, 401k maximization. See the 2025 limit in employee contributions, plus if you are 50 or older, you have additional catch up contribution. So if Rajesh is not maxing this out, and statistically, most high earners in our practice are not fully maxing it. Every dollar he puts in reduces his taxable income dollar for dollar. And at his marginal rate of around 32%, that saves him roughly $7,500 in federal taxes alone, just from 401k, plus FICA savings, if below, the social security wage base. Now, quick question, is your 401k maxed out for 2026? You would be surprised how many 300,000 plus earners are not maxed out. Step 2, HSA. I call it as the triple tax advantage. So if you already enrolled in a high deductible health plan, you can contribute to a health savings account, right? The limits keep changing every year, and I encourage for family contribution. The HSA is the only account in the entire US tax code that gives you 3 layers of tax benefit. Contributions are pre-tax, growth is tax-free, and withdrawals for qualified medical expenses are also tax-free. Nothing else does all three. Nothing. Not 401k, not Roth IRA, but only the HSA. Step 3, the SALT strategy with the new cap that I told you. So if Rajesh is in a state with income taxes, like Washington DC, Maryland, Virginia, and owns a home, the new SALT rule significantly changes itemized deduction calculation. This can move him from taking the standard deduction to itemizing, unlocking the additional savings. Then step 4, excited to hear? Backdoor Roth IRA. See, Rajesh earns too much to contribute directly to a Roth IRA. The income limit for direct Roth contributions in 2025 was some 161,000 for single, 240k for MFJ, married filing jointly. But there's a completely legal workaround, the backdoor Roth. You contribute to a traditional IRA, no income limit for non-deductible contribution, and then immediately convert it into a Roth. But be careful, if you have an existing pre-tax IRA balances, the pro rata rule applies and you could owe taxes on that conversion also. So this must be done with proper guidance. Now total result, what happens here? $12,000 in real tax savings. From 1 year of planning for a W2 employee. No business, no magic, just strategy. Now multiply that for 10 years. $120,000 in saved taxes. That could have been in Rajesh's pocket or invested or sent back to parents or family in India. Think about Suresh and Priya, and another client, both working, married. If both have access to HSA eligible plans, they can contribute over $8,000 to family HSA. And at their combined marginal rate, that is $2,500 in immediate federal tax savings just from one account. From one account. Think about it. Yeah, I'm giving you very valuable information. Somebody can start tax planning business with this. Now, don't be surprised if you are getting some tax planning service requests from others in the industry after watching this video. You might have never seen them, approaching you for tax planning. So probably after this, समझ लेना कि कॉम्पिटिटर पढ़ रहा है, हमारा क्लाइंट नहीं. कॉम्पिटिटर पढ़ रहा है हमें, क्लाइंट नहीं. चलिए, केस स्टडी 2, the S Corp business owner. Now let me talk to my business owners, consultants, freelancers, IT contractors working on 1099, small business owners with LLC, S Corp, C Corp, partnership, whatever. This case study is specially for you, and the numbers here are even more dramatic. Okay, so meet Anand, Mr. Anand. Okay, he runs a small IT consulting firm. His S corporation generates some $250,000 in net income after expenses. Without planning, every dollar of that $250,000 flows through to his personal return, right? Pass through entity, and gets taxed as ordinary income. It is marginal rate. But there is a better way. There is a better way. 4 strategies, that saved Anand over $18,000 in just 1 year. Strategy 1, reasonable compensation split. Reasonable compensation split. Here is something most people do not realize. In an S corporation, you must pay yourself a reasonable salary. But income above that salary can be taken as a distribution, and distributions are not subject to self-employment tax, which is 15.3% on the first 176 100 of wages for 2025, and 2.9% Medicare tax above that. So if Anand pays himself $120,000 in taxes and takes $130,000 as a distribution, he saved almost like $3,770 in Medicare taxes alone. Write to me to check what it is for 2026. But this works only if the salary is truly reasonable, as per the IRS standards. Setting it too low is a red flag for audit, and this is where professional guidance is critical. Solo 401k. As an S Corp owner, Anand can contribute to a solo 401k as both the employee and the employer. As an employee, he can defer up to 23,500, as in 2025. As the employer, the S Corp can make an additional profit sharing contribution of up to 25% of W2 compensation. So the combined limit can reach up to $70,000 in 2025. Now 72. That 72 contribution reduces his taxable income by that much amount. So at a 32% federal rate, that is 22,400 in federal tax savings alone. Now, strategy 3. Section 179 expensing. Did Anand buy a new computer, new software, office furniture, or any equipment for the business this year? Under Internal Revenue Code Section 179, he can deduct the full cost in year 1 up to 1.22 million. You know that? Limit is adjusted annually. So instead of depreciating a 30,000 piece of equipment over 5 years, like 6,000 per year, Anand can deduct all 30,000 in a single year. That is section 179. Then, strategy 4. Learning, business owners, exciting. Expense optimization. Home office, vehicle, phone, internet, subscriptions, professional development, equipment. If these are legitimately used for business, they are all deductions. The key here is documentation. Documentation. The IRS doesn't take your word for it. You need logs, receipts, records. But when done correctly, these can add up to thousands of dollars, in additional deductions. $18,000 in total savings. For Anand, that is essentially a full year of solo 401k contributions, meaning he is building retirement wealth and reducing his taxes at the same time. So, if you are currently operating as a single member LLC or sole proprietor and your income is above $50,000 or $60,000 net, you may be a candidate for S corporation election, and you may not even know it. Just get in touch. करते हैं कुछ, कुछ अच्छा करते हैं, बड़ा नहीं तो कुछ अच्छा करते हैं. चलिए, केस स्टडी 3. The NRI PFIC trap. This is the most important slide of the day. I want every Indian in this audience to listen to this carefully. If you have Indian mutual funds and any mutual funds registered in India, you have what the US tax code calls a PFIC, a passive foreign investment company. Let me explain what this means and why it matters. See, in the US, when you sell a stock or mutual fund that you have held for more than 1 year, you pay long term capital gains tax 0%, 15%, 20%, depending on your income, right? Very favorable rates. But Indian mutual funds are not treated that way by the IRS. They are classified as PFICs. And under the PFIC rules, specifically Internal Revenue Code, section 1291, the default tax treatment is extremely punitive. Here is what happens. So, if you are an NRI who moved to the US, say 5 years ago, and you have been holding SBI Blue Chip Fund since 2018, you did not sell it, you just held it. But now in 2025, you receive an excess distribution, which includes not just dividends, but also gains that exceed 125% of the average distribution over the prior 3 years. The IRS applies an interest charge going all the way back to the year you first became a US tax resident. Let me say that again. The tax is compounded as if you have received that income evenly across all the years you held the fund. And then they apply an interest charge, currently around 8% per year, on the deferred tax amount. Let me talk about a client, Ravi. He came to US in 2018 he sold, he held an Indian mutual fund worth $100,000. By 2025, it grew to $200,000. He sells it. In India, he would pay 10% long term capital gains tax, some $10,000. Now, in the US, without proper elections, watch my PFIC videos. I encourage you to watch those PFIC videos in the same playlist that you're watching this video. So, in India, he would pay 10% long term capital gains, $10,000. Now, in the US, without proper elections, his effective tax rate, including the Section 1291 interest charge, can significantly be higher than the top ordinary income tax rate of 37%. The interest accruing over 7 years adds substantially to the bill. Same money, same investment, but wrong tax strategy. Massively different outcome. But here is the good news. This is where planning matters. There are two IRS elections that can dramatically change this situation. First, the QEF election, yani the Qualified Electing Fund election. You make an annual election to include the fund's ordinary earnings and net capital gain in your income currently, even if you did not receive them in cash, even if you did not sell them. This sounds painful, but it means your eventual sale is taxed at preferential capital gain rates. So, this is much better. Second, the mark to market election. You elect to mark your PFIC holdings to market at year end, recognize gain or loss annually. This avoids the interest charge trap entirely. Now, here is the critical problem. See, both of these elections are prospective. You cannot go back 5 years and make a QEF election retroactively in most cases. You cannot. And if you miss it them, you are in the default section 1291 regime, which is very bad. See, I'm willing to bet that most of you have never filed Form 8621, which means there is a compliance issue that needs to be addressed. What is this Form 8621? See, this form, annual return by a shareholder of a passive foreign investment company or a qualified electing fund, is required for every PFIC you hold above a certain threshold. And it is one of the most commonly missed forms we see. And the IRS has been increasing enforcement on exactly this issue. The three case studies. Can you take a look at this three case studies before I take you to my ABCDEF framework? Yeah, take a moment. Sorry, it's a live video. I don't do any editing or anything. I just record it and then just goes live streaming. Now, I want to give you a framework, a mental model that you can think about, your own tax situation. So I call it as ABCDEF framework. Some of my clients who are my students for US payroll, US taxation, US bookkeeping, it's a revision for you here. Yeah. So most taxpayers and unfortunately some tax professionals also, whether CPAs or EAs, only look at D, deductions. Standard deduction, itemized deduction, mortgage interest, charitable contribution. That's it. But smart taxpayers use the entire alphabet. Now, A, I've just taken some six. Okay, A is for adjustments. These are above the line deductions, meaning you get them regardless of whether you itemize. Getting? Whether you itemize student loan interest, HSA contributions, educator expenses, alimony for pre 2019 agreements, self employed health insurance premiums. These reduce your AGI, that's your adjusted gross income, which is the foundation of almost every other tax calculation. Example, if you reduce your AGI, you may also become eligible for credits that were previously phased out. So, one adjustment can unlock multiple downstream benefits. Next, B is for benefits. See, specifically, employer sponsored pre tax benefits, FSA, flexible spending account, dependent care FSA, commuter benefits, group term life insurance, up to $50,000. These are dollars that never become taxable income. If your employer offers these and you're not using them, you are paying taxes on money you did not have to. Then C is for credits. These are even more powerful than deductions because they reduce your tax dollar for dollar. The child tax credit, education credits like the American Opportunity Credit, the foreign tax credit for taxes paid to India, then the EV credit up to $7,500. Of course, the old one. If you brought a qualifying electric vehicle, then D is for deductions, the one everyone knows. Standard versus itemized, salt, mortgage interest, charitable contribution, medical expenses above 7.5% of AGI. The new legislation changed some of these significantly. Next, E is for exclusions. This is income that never enters the taxable calculation at all. Your employer pays health insurance premiums for you, that is tax free. Qualified adoption assistance, that is tax free. The home sale exclusion, up to $500,000 of profit on sale of home, capital is not taxable if you lived in the home for 2 out of the last 5 years and then you sold it. Then F is for foreign compliance. F bar, FATCA, PFIC, all these forms, FTCs, foreign tax credits. For Indians in the USA, F is often the most important and the most missed letter. Entire retirement savings back in India, NRE, NRO accounts, family property, all of this potentially has the US tax and reporting implications. Now, here is a diagnostic question for you. When was the last time your tax preparer asked you about every one of these six areas, A through F? If the answer is never, that tells you a lot about what kind of service you have been getting. Now, the iLead framework, okay? The CO level tax planning. See, at iLead tax, before we build a single strategy for a client, we do a complete analysis of their financial life. Not just last year's tax return, but their entire financial picture. We use what we call the iLead framework. I stands for income. not just salary. All income, W2, RSUs, dividend, interest, rental income from properties in India or US, business income, capital gains, foreign income. The type of income matters enormously. Ordinary income is taxed differently from capital gains, which is taxed differently from passive income, which is taxed differently from qualified dividends. So, understanding what type of income you have is the foundation of every strategy. Next is L. L is for liabilities. Your mortgage, student loans, business debt, home equity lines. These liabilities create deduction opportunities. Mortgage interest, student loan interest, and they affect your cash flow planning. If you have significant debt, we factor that into how aggressively you can contribute to retirement accounts. Then E stands for expenses, both personal and business. Medical, education, business expenses, charitable giving, home office. So we analyze these not just to find deductions you missed, but to help you time and structure future expenses for maximum tax impact. Next, A stands for assets. Your 401k, IRA, taxable brokerage account, real estate, foreign holdings, equity in your business. The mix of your assets, taxable versus tax deferred versus tax free, is one of the biggest drivers of long term tax efficiency. And this is what financial planners call asset allocation. It's a science. So if you have your bonds in your taxable account and your stocks in your 401k, you are probably doing it backwards. Interest income is taxed at ordinary rates, capital gains are taxed at preferential rates, and switching their locations can save you taxes every single year. Next, D is for dreams. I have a dream, right? This might sound unusual in a tax conversation, but your goals shape your strategy. Are you planning to retire in the next 10 years? Are you thinking about returning to India? Are you funding college for your kids? Are you trying to start a business? Do you want to buy a home in the next 2 years? Your dreams, they determine your timeline. And your timeline determines which strategies make sense. A 35-year-old planning to stay in the US long term has completely different optimal strategies than a 52-year-old taxpayer planning to return to India in the next 5 years. So, this is a CEO level financial thinking applied to your personal tax situation, and this is what this iPlan tax sessions are built around. Now, what happens if you don't plan, by June 30? I want to be very concrete with you about what happens. Not hypothetically, but mathematically, okay, when you delay tax planning past June 30. See, inaction is a choice, and it is the most expensive choice most taxpayers make. And here is what you are literally choosing when you delay. First, you lock in higher taxes. You lock in higher taxes. Some strategies have hard deadlines, embedded in the tax code. For example, an S corp election must generally be filed within 75 days of the start of the tax year or within 75 days of formation to be effective for the current year. You miss that window and you wait another full year. Retirement elections, your ability to fund a solo 401k or make employer contribution also have year-end deadlines tied to when the plan is established. So all these get affected. So timing matters. Second things, deductions disappear. HSA contributions must be made by December 31st, but legally you can make it, by April 15th of the following year too. But you need to be enrolled in a qualifying health plan during the year to be eligible. So if you are not in the HSA eligible plan right now and you wait until December to switch, you may only have 1 month of eligibility. You cannot retroactively enroll for January through November. Third, credits expire if unused. The EV credit, education credits, dependent care credits, these require qualifying activity during the tax year. You cannot claim what you did not do. Next, fourth, the penalties next year. If you are not adjusting your withholding or making estimated quarterly payments based on your projected 2026 income, you may be significantly under withholding right now. So, every month that goes by without a projection, the gap grows larger. By December, it may be too late to catch up without facing the full underpayment penalty. See, the IRS underpayment penalty is currently around 8% per annum. So, on a $20,000 underpayment, that is $1,600 in pure penalty. Avoidable, completely avoidable with a mid year planning. Let me ask you a genuinely important question. Do you know right now, today, approximately how much you are going to owe the IRS on April 15, 2027 for this 2026 tax year? If your answer is I have no idea, that is a problem. And that is exactly what we are here to solve. Delay is not neutral, but every month, without a plan is a month the IRS benefits at your expense. And that's why I say June 30 is critical. Let me explain, why we always say that June 30 is a critical deadline and why this is mathematical, okay, not marketing. See, think about the tax planning calendar in 4 phases, okay? Quarters. Phase 1, Jan through March. This is tax filing season, okay? Anybody who comes in April, for lack of better words, थोड़ा careless हो आप. You're a little careless. You don't care about money, maybe. That's okay. You may be super rich also. Or maybe taxes are not a priority for you. So, Jan through March, this is your tax filing season. Everyone is focused on the past year. Your EA, your CPA, H&R block, TurboTax, all focused, on last year. Let's say 2025. And the planning for 2026 gets zero attention. So, this is a huge missed opportunity. Phase 2, April through June, now that we are in. And this is the golden window. You have just finished filing, so you know exactly where you stood last year. You have 6 months of the new year ahead of you. Enough time to implement every strategy. You have pay steps to project forward, business revenues are becoming clearer, RSU vesting schedules are known, and this is where real planning happens. Phase 3, July through September. The window is narrowing. Some strategies still work, but execution becomes rushed. So, if you need to establish a solo 401k, set up a business entity, or make significant withholding changes, the later you start, the less time you have to fine tune. Next, phase 4, October through December. Year end scramble. Most people call us in November, saying, I just got a big bonus. Or my RSUs vested and I have a huge tax bill coming. By this point, many options are already closed. We do emergency triage. Some things can still be done, but it is not optimal. You are paying for delays made months earlier. After June 30, you still have half a year of income to accumulate, but you have lost the ability to proactively structure half a year's worth of strategy. Think about it like planting a garden. See, you can plant seeds in the current window, April, May, June, give them the whole growing season. Or you can try to plant in October and wonder, why nothing grows. Tax strategies work exactly like this. They need time to grow. Retirement contributions need time to grow. Structural changes need time to settle. The earlier you start, the more impact you get. June 30 is not a marketing deadline. Pierce, if somebody think like that. It is the point at which we have looked at the calendar and said, from here forward, you begin losing options. Do not let that happen. Now, what you should do starting today. All right, see, everything I have covered so far was diagnosis. Now, let me give you the prescription. 4 concrete steps, okay, in sequence. Do not skip the steps, do not do them out of order. This is the exact roadmap we walk every planning client through, okay. Step 1, start with phase 1 tax planning. Phase 1 tax planning. Book a 60 minutes iPlan session with me. This is not a generic consultation. There's a dedicated focus session where we go through your entire financial picture using the iLead framework that I explained you. So we'll look at your income sources, your liabilities, your expenses, your assets, your goals. We will identify every planning opportunity. You will leave with a real actionable list, not some vague advice. Okay. Then step 2, analyze your 2025 tax return. Your just filed return is a gold mine. It tells us exactly what happened last year. And when we look at it with planning eyes, not just compliance eyes, we can see what was missed, what can be done differently this year, and what creates opportunity going forward. Example, if your 2025 return shows a large capital gain in your taxable brokerage account, that signals an opportunity for tax loss harvesting in the second half of 2026. If it shows RSU income not properly accounted for, we will adjust your W4 now. Step 3, project your 2026 income. Using your current pay stubs, your RSU vesting schedule, your business revenue trends, any expected bonuses, we calculate your projected 2026 tax liability. This is the number you need to know right now, not in January 2027. Now, ippudu, ippo, aaj, ab. Step 4, lock the strategies before June 30. See, retirement elections, withholding adjustments, entity deductions, investment moves, all of these get confirmed and calendared before the planning window closes. You should have a specific action item for every month between now and December 31st. Let me say that, last part again, a specific action item for every month. June, max your HSA contribution. July, review estimated tax payment. September, evaluate portfolio for tax loss harvesting. November, final withholding check. December, make solo 401k employer contribution. How many of you have a month by month tax action plan right now? The answer is zero. At least start following this. Now, what iLead does for every tax planning client. Let me take a moment, and tell you specifically what we do for every planning client at iLead Tax LLC. Because I want you to understand the difference between what we do and what a standard tax preparer does. See, first, we detect the hidden tax leakages. Most people have money quietly leaking out through avoidable taxes and they do not even know it. We go through every income source, every account, every transaction with planning eyes, not just data entry eyes. We ask, is this optimally structured? Is there a better account for this? Is this deduction properly documented? Is this investment causing unnecessary tax drag? Example, one of our clients, an IT manager earning some $280,000, did not realize that his dependent care FSA was not fully utilized. His employer offered $5,000 in dependent care benefits, but he was only contributing $2,000. That remaining $3,000 in potential pre-tax savings was simply not being used. That cost him roughly some $900 in unnecessary taxes every year. A small thing, but multiply it across a dozen categories and it adds up fast. Second, we build your personalized iPlan. It's a written, actionable tax strategy document, estimates, not generic advice. Your iPlan tax estimates is specific to your income, your visa status, your family situation, your investment portfolio, your goals, and it is the difference between a custom suit and something off the rack. I mean, a proper body fit suit versus something जो लटक रहा है आपके shoulders पे. Next, third, we show you the exact tax savings in dollar amounts, not vague promises. Before you decide anything, you see, if you make this contribution, you save X. There might be 5 to 10% deviation at the end in case you get additional income or you get less income. But if you act on this, it can definitely benefit you. We may say, like, if you make this entity election, you save this much. So you have the numbers, you make the decision. Fourth one, we protect you from any IRS issues. I see some companies charging peace of mind guaranteed, tax representation guaranteed. We don't charge anything from you on those lines. Just sign up for the planning services that will cover you all. Prevent, I mean, penalty prevention, proper estimated tax payments, FBAR, FATCA compliance, audit ready documentation. This is especially critical for NRIs. See, the IRS has significantly expanded its international enforcement activities in recent years. That's why I came up with so many videos on PFIC also. You want every position you take to be defensible with paper trail, with citations, with proper elections made on time. Now, what actually happens in your planning call? Okay, let me walk you through what exactly happens in your 60-minute iPlan call with me over Zoom. Okay, this is not a sales call. I'm going to say that again. Okay, this is not a sales call. It's a working session, a real strategy session. What is there for me to sell you? I'm not going to tell you, work with that bank, this fund. No, we are not tied up with any bank or fund or any insurance company. You are free to do it. I am going to tell you just the strategies. You decide who is the vendor. So don't think that, oh, Nanda is tied up with so and so, stockbroking company, so and so insurance company, oh, so and so money market vendor. All these are your assumptions. See, my team and I, we are going to do actual work here. Now, we will review your income. We go through all your income sources, W2, RSUs, business income, investment income, any foreign income. We establish your total income picture and then income type mix. Next, we check your taxes. We look at your 2025 return and your current year to date situation. How much have you paid through your pay stubs and all? How much are you projected to owe? Is there a gap? 3. We project your 2026 using your pay stubs, vesting schedules, business projections, even the family structure. We calculate where you are going to land as on December 31st, 2026. This gives us the number we are trying to optimize. And a majority of my iPlan clients, they schedule even the second session because in the first phase 1 planning, the planning happens. Then in the phase 2, the review happens. If you go to the description, you will see those links there. You can leverage that. No, I cannot invest $10 a month. That is too expensive for me. At least get the tax estimates, review it for yourself, and see, what you can do for yourself. Next, we find deductions and then credits. We go through every applicable category, whether retirement, HSA, entity structure, SALT, foreign compliance, treaty positions. We identify every opportunity that applies to your situation. And then finally, the action steps. You leave with a written prioritized list of specific things to do by when and the expected tax savings of cash. You will get a 2026 tax summary, tax estimate report. Most clients leave the call knowing three things. One, their projected 2026 tax bill. Their two, their top three saving strategies. And then three, their exact next steps. Now, this is not theory, this is implementation. Now, for Indians in the USA specifically, we also flag any foreign reporting requirements that may apply. So, if you have NRE accounts, mutual funds, PPF, family property back in India, we identify what needs to be reported and then when. Now, I want to talk about the mistakes. About the mistakes Indians in the USA make most often. I think this is one of my favorite slides to teach because it is based on my 22 years of real client experiences. So these are not some textbook mistakes. So my students, if you are watching, this video, you might be thinking, "अरे sir, ये सब ये में नहीं पढ़ा है." Yeah, ये RTP में ये सब नहीं पढ़ा है. That's why I encourage you to watch this also. Yes, education gives you just that qualification, but it's the real-time case studies that give you that wisdom, understanding. That gives you only knowledge and qualification. iLead Tax Academy gets you that knowledge and qualification, but you build wisdom and understanding through handling real claims at iLead Tax LLC. Yeah. So these are patterns I see repeatedly, across every visa type, every income level, every state. So if any of these, my dear clients, describe you, do not feel embarrassed. You were not in my mind when I wrote this, when I made this presentation. Okay. But many like you were in my mind when I made this. These are common, precisely because the US tax system is enormously complex. And the intersection of the Indian and American financial lives add multiple additional layers. Now, let's see this. Mistake one, holding Indian mutual funds without understanding the PFIC rules. See, I covered this at length in my 6 PFIC videos. I think more than 6 hours I have spoken. 6 to 8 hours probably. We covered this. So if you have Indian mutual funds and you have not filed Form 8621, you have a compliance gap. Period. The question is how to fix it, and the good news is it is fixable. Okay? If you schedule a consultation. Don't expect answers for that also. Answers for your situation also in a YouTube video like this. Okay. Next, mistake 2. Missing FBAR and FATCA. Your NRE account, NRO account, PPF, EPF, joint accounts with family in India, all of these, may have US reporting requirements. The FBAR, FinCEN Form 114 must be filed if the aggregate balance of all foreign financial accounts, they exceed $10,000 at any point during the year. Not at the year end, at any point during the year. अभी नंदा जी मैं कैसा देखूं? देखना है आपको. बैंक स्टेटमेंट डाउनलोड करना है, देखना है. You are too lazy to find out? Email us, we will tell you. Or you have a paid AI tool or anything. There are so many tools now. Upload it, ask, did I have at any point in time more than $10,000 I am required to file F bar and fat car. This guy is scaring me through this video. Scaring नहीं है, ये correcting है, scaling है ये. The penalties for non-willful non-compliance were clarified, in Bittner versus United States case. Now assessed per filing rather than per account. But willful violations still carry devastating penalties. I'll tell you a situation. Meera, she came to US 3 years ago. If you are watching, I have changed the names, okay? So don't worry. She came to US 3 years ago. She had been in the US on H1B for 7 years. She had an NRI account in India, about $150,000, an NRO account with $30,000, and her PPF from before she came to the US. She had never filed an F bar, never reported her NRO interest income on her US tax return. She did not even know she was supposed to file this F bar. We helped her use the IRS streamlined filing compliance process to get compliant. She paid a 5% offshore penalty on the highest aggregate balance, manageable, and now is fully compliant. But the stress she went through was enormous. So do not wait. Next, mistake 3. RSU over withholding gap. I covered it earlier. The 22% flat supplemental withholding rate is almost always insufficient, for high earners. Adjust your W4 after every significant vesting event. Next, mistake 4. Wrong entity structures. Business owners, people who want to, I have a dream. You have a dream, you need a coach, you need a mentor. Even Ekalavya needed Dronacharya. If you are self-employed and netting more than 50,000 to 60,000, you are almost certainly paying more in self-employment tax than you need to. The S Corp election, when done properly, is the single most impactful structural change for many of our business owner clients. Next, mistake 5. No estimated tax payments. See, under Internal Revenue Code, if you owe more than $1,000 at filing and have not paid enough through withholding, you owe an underpayment penalty, जिसको प्यार से estimated tax penalty बुलाता है IRS. For self-employed people and business owners, quarterly estimated payments are due by April, June, September, and then January. And how you stay compliant is something that you have to figure out by discussing with your tax consultant. Missing this is a very avoidable expense. Next, mistake 6. Ignoring US India treaty benefits. See, the US and India have a tax treaty. The 1989 Income Tax Convention. Most Indian professionals in the USA have never had a tax advisor even mention this treaty to them. Probably you are listening from me for the first time. There are specific provisions around pensions, government service income, student income, and then more. Now, are you claiming every benefit you are entitled to? If nobody has analyzed your specific situation against the treaty, the answer is probably no. People don't know, what forms also. Forms. For them, 1040, 1040 NR, both are same. No. Let me quickly, go through the key forms that applies to Indians in the USA, because compliance starts with knowing which forms you need to file. Even if you are somebody who came to US for the very first time, or you don't know, you just filed, because your friends are filing through that vendor, your company recommended so and so vendor, you just submitted the documents and they filed it. But please, no, no, but I'm paying, Mr. Nanda, to engage their services. They should be doing it right. Correct, correct. But I'm asking you to review. They will do it right. Most likely, 99% they may do it right. But that 1%, you review. Missing a required form is not the same as making a mathematical error. Missing certain forms, especially international forms, they carry independent penalties that can exceed the tax itself. Now, Form 1040, this is the master US individual income tax return. Every US tax resident, including H1B, L1, green card holder, and citizens, must file this. When I came into US taxation, I fell so much in love with this that my Royal Enfield Bullet number is still 1040. So, if you are on OPT or F1 and are still a non resident alien, you file Form 1040 NR instead. This residency determination is based on substantial presence test, under the Internal Revenue Code. And it is critical and is often misunderstood. Next is Form 8938. Statement of Specified Foreign Financial Assets. Now, this is the FATCA form. It is filed with your 1040. The filing threshold is $50,000 for single filers, $75,000 if any time during the year, or $100,000 for married filing jointly, $150,000 if any time during the year. And the penalty for non-filing is $10,000 and up to $50,000 for continued failure to file. Next, FinCEN 114. FBAR, Foreign Bank Accounting Report. It is filed separately from your tax return, electronically through the FinCEN FBA BSA e-filing system. Due date is April 15th, but with automatic extension, it goes to October 15th. Okay, so if all your foreign accounts combined have ever exceeded $10,000 in the calendar year, you must file this. Even if you are filing with iLead, keep following up. In follow up is fortune. In follow up is form compliance also. Okay, and note that FBAR and Form 8938 overlap in some ways, but they have different thresholds, different forms, different penalties, and you may be required to file both. Filing one doesn't mean that you can ignore the other. Okay, next, Form 8621, what most of my clients don't like. PFIC, annual reporting, required for each PFIC held. Often missed entirely, no statute of limitations for PFIC related tax understatements in some cases. Form W4, withholding certificate. This is what your employer uses to calculate how much federal income tax to withhold. Now, if you have had a significant income event, RSUs, bonus, marriage, divorce, new child, child born and died during the year. I'm sorry, I have to mention this because I've seen that preterm delivery cases, purchased a new home, selling a home, moving to a different state. Update your W4. You know, we can help you on that. Next, Schedule SE, self-employment tax. If you have any self-employment income, consulting, freelancing, side income, you owe self-employment tax of 15.3% on the first social security wage base limit. Like for last year it was 176,100. This is separate from income tax. Again, you will have 2%, 2.9% Medicare tax also above that. So many people are blindsided by this. Next is Form 2210. What I told you just now, underpayment penalty. This calculates your underpayment penalty automatically. So if you owe a penalty, review this form with your advisor. There are exceptions and safe harbors that can reduce or eliminate it. You should be able to see it in your last year tax return copy too. Okay. Now, Let me talk about the some of my RSU clients. Okay, let me go a little deep on RSUs, because if you worked in tech and you have stock compensation, this section is specifically for you. RSUs, restricted stock units, are the most underplanned element of tech compensation, and the mistakes here are expensive and very consistent. Here is how RSUs work for tax purposes. See, when your RSUs vest, the FMV of the shares on the vesting date is treated as ordinary income, not capital gains. Ordinary income, taxed at your highest marginal rate. So your employer reports this on your W2. They also withhold taxes, but here is the problem. IRS Publication 15 requires employers to withhold at the supplemental wage rate, which is a flat 22% for amounts under 1 million. But if your total income is 400,000 or more, your marginal tax rate is 35% or 37% plus state taxes. So there is an immediate 15-point gap, between what your employer withholds and what you actually owe. Let me talk about one of our clients, Nikhil. Nikhil works at Amazon in Seattle. No state income tax, good for him. Base salary 180,000. RSUs vest some $200,000 worth. His employer withholds 22% on the RSU income, some 44,000. But his actual marginal federal tax rate on that income is 35%. So he owes 70,000 on the RSU income. He gets credit for the 44,000 withheld, but now he owes an additional $26,000 plus Medicare and then underpayment penalty. Surprise for April 2027. Now, what should Nikhil do? Yeah, of course, contact iLead and then adjust his W4 immediately. After each significant vesting event, he should update his W4 to increase additional withholding and then close the gap. Second, use the RSU income to fund the mega backdoor Roth. If his employer's 401k plan allows after tax contribution and in service withdrawals or in plan Roth conversions, he can contribute additional after tax dollars also to his 401k up to the annual additional limit of $70,000 and then convert them to Roth. This creates the tax free growth on a very large sum. Then, third, strategic sell timing. Strategic sale timing. If he holds the shares after vesting, any additional gain after the vesting date is capital gain. You hold it for more than 12 months, it becomes a long term capital gain. Maybe it may be taxed at 0%, 15%, or 20%. Now, this is not free. He already paid income tax at vesting. Not on the appreciation after vesting, he can get those preferential rates. Now, fourth, pay with charitable organizations. If he donates some appreciated stock instead of cash, he avoids reorganizing or recognizing the capital gain, on the donated shares and gets a charitable deduction for the full fair market value. Extremely powerful, for high income tech employees who want to give charitably. Now, a note on ESPP also. If your company offers a ESPP, Employee Stock Purchase Plan, the discounted purchase is ordinary income in the year you sell, not the year you purchase. Okay, and it gets more complex with qualifying disposition, non-qualifying disposition, and all. So, do not sell ESPP shares without understanding the tax mechanics first. How many of you have RSUs vesting this year? Get in touch. Get in touch or start working on that. Okay. Take a look at what we have done so far and let me know how you feel in the comment section. It needs a lot of dedication and commitment to watch the video this far. Kudos to you if you're watching it still in a single take. Yeah, just like the way I'm doing it in a single take. Now, let me talk about the retirement strategies that reduce taxes now. See, retirement accounts are not just about your future, they are the most powerful tax reduction tool available to you right now. Today, this year, every dollar you contribute to a traditional 401k or traditional IRA reduces your taxable income today by $1. By $1. At a 32% marginal rate, 401k saves you more than $7,500 in federal taxes alone. Immediately. Let me go through the key accounts, like 401k. And then if you are 50 or older, you can add another 7,500. Now it is 24,500 for 2026. Now, under the Secure 2.0 Act, if you are between ages 60 and 63, you qualify for a super catch-up contribution of $11,250 instead of $7,500. If you are in that age range, this is huge. Talk to your HR or payroll department today. If your employer also makes matching or profit sharing contribution, the total from all sources can reach $72,000. Add the relevant catch up contribution accordingly. Next, HSA. I think I explained this already. So, if you are enrolled in a high deductible health plan and you are not contributing to an HSA, you are making a financial mistake. It's that simple. I told you about the triple tax advantages also. And after age 65, you can withdraw for any purpose. Just pay ordinary income tax like a traditional IRA. So the downside risk also essentially disappears. Next, the third one is backdoor Roth IRA. If your income exceeds Roth IRA contribution phase out limits, you cannot contribute directly to a Roth, but you can make a non-deductible contribution to a traditional IRA and immediately convert it into Roth. This is completely legal and has been approved by the IRS. But only if you have no other pre-tax IRA balances, as I told earlier. If you do, the pro rata rule applies and you will owe taxes on that part of conversion also. I'm warning you again. Yeah? So plan carefully. Next, solo 401k for business owners. If you have self-employment income, even a side consulting gig, you can establish a solo 401k and contribute up to annual additions limit as both employee and employer. At $250,000 of self-employment income, this could allow contributions of $70,000 or more, reducing your taxable income by that full amount. Example, Kavita runs a healthcare consulting practice and she makes, some $300,000. She establishes a solo 401k. Okay. And she contributes $23,500, let's say, as employee. As employee, she's contributing some $23,500. The business makes an employer contribution of 25% of her W2 compensation. So, total contribution nearly some 70,000 plus. So, at her 32% federal marginal rate, that is 22,400 in immediate federal tax savings, plus the state taxes are also getting saved. What retirement accounts do you currently have? 401k, IRA, HSA? Let's talk. because the combination strategy is where the real savings happen. Hmm? Next, the cross-border tax strategy. This is the slide that separates the general US CPAs from the cross-border specialists. So if you have any financial connection to India, accounts, property, investments, family, this section is essential. The US taxes its residents and citizens on worldwide income. As I told in many videos, it taxes on the worldwide income. This is not optional, this is not avoidable. If you are a US tax resident, which includes, most of our H1, L1 green card and all citizens, income from India is taxable in US. Know that. Okay. Now let's take one by one. NRE NRO accounts. See, your NRE account, this non-resident external account, holds foreign currency earnings. Interest earned in NRE accounts is generally tax-free in India, but it is not automatically exempt from US tax. The US taxes the NRE interest income as ordinary income on your 1040 Schedule B. Additionally, if the aggregate balance of all these foreign financial accounts exceed $10,000, as I told earlier, both the NRE and NRE accounts, then you may have a FBAR reporting also. And if the balances exceed the FATCA limits of $100,000, then Form 8938 FATCA form also applies. Next, EPF and then PPF. The EPF, Employees Provident Fund, and Public Provident Fund are two of the most mishandled items we see for NRIs. These are not automatically tax free in the USA. Employer contributions to your EPF may be includable as income in the year of contribution under US tax principles. The US India tax treaty contains limited relief for government pension schemes but does not clearly cover EPF, as a treaty exempt pension for all purposes. This area requires a proper case by case analysis. So do not let any accountant tax guy tell you categorically that EPF is either fully taxable or fully exempt without performing a proper treaty analysis that I told you earlier. Yeah? Next, Indian rental property. If you own an apartment in Bangalore, Hyderabad, Mumbai, anywhere in India, and you collect rent, that rental income is reportable on your US tax return on Schedule E. You can deduct expenses, property tax, mortgage interest, repairs, depreciation using the US depreciation methods against the rental income. Most of the time, it will be loss only. And taxes you paid in India on that income can be claimed as a foreign tax credit on 1116 form to avoid true double taxation also. Next, gifts and inheritances from India. If your parents or family members send you gift exceeding $100,000 in a calendar year, aggregated across all foreign persons, you are required to file Form 3520, annual return to report transaction with foreign trusts and receipt of certain foreign gifts. Now, let me warn you here. This is a reporting requirement. The gift itself is generally not taxable to you as income. Okay, first note that. But failure to file 3520 carries a penalty of 5% of the gift per month up to 25%. And many people confuse not taxable with not reportable. They are different things. Okay. Suresh received an inheritance from his father in India, 2 crore, approximately $240,000, let's say. He did not file 3520 because the tax guy never told him inheritances about inheritances. And when he heard He was told that inheritances are not taxable, which is correct from an income tax perspective, but the reporting requirements still existed. And the potential penalty, 25% of 240,000, $60,000. Fortunately, he came to us before the IRS noticed. We filed a reasonable cost statement and got him compliant. How many of you have received money transfers from family in India? Gifts, loans, inheritances. This is more common than you think and more commonly unreported than it should be. Get in touch. Now, let me be very direct with you here. This is not fear mongering. This is responsible education. You need to understand what is at stake if your tax situation is not in order. क्या होता भाई? See, the IRS has dramatically increased enforcement activity targeting three specific groups. The little that I know, based on my last 22 years of experience. One, international taxpayers. Two, high earners. Three, cryptocurrency holders. If you fit into any of these categories, and most of you watching do, you need to take this seriously. Okay. Now, underpayment penalty. If you owe more than $1,000, I think I have told this so many times in the video, because your tax consultation cost is very negligible compared to the estimated tax penalty that you are paying here. इसीलिए दुख होता है हमें. If you owe more than $1,000 at filing and you did not pay at least 90% of your current year tax liability or 100% of your last year's liability, whichever is smaller, you owe an underpayment penalty. Currently, that rate is approximately some 8% per annum. So, on a $30,000 shortfall, that is $2,400 in pure penalty. On 100,000 shortfall, which happens, that is $8,000. Next is F bar non-filing. See, post this Bittner's case, the non-willful penalty is assessed per form rather than per account. Note, peers also, even students know this. So, a non-willful filer with 5 accounts, all in 1 year, faces one penalty of up to $10,000, not 5. However, if the IRS determines your non-filing was willful, and willful under the law is interpreted broadly, the penalty is the greater of $100,000 or 50% of the account balance per violation, and that is per year of violation, not per account. Criminal prosecution is also possible in some extreme cases. Example, an NRI client had $500,000 in Indian bank accounts for 5 years without filing F bar. If deemed willful, 50% of that $500,000, यानी आधा, $250,000 per year of violation. 5 years means 1.25 million in potential penalties on top of any tax owed. This is not hypothetical, it has happened. It has happened. But the good news, the IRS has compliance programs, streamlined domestic and streamlined foreign offshore procedures that significantly reduce penalties for non-willful filers who come forward voluntarily. Next, the PFIC default tax. See, without a QEF or a mark to market election that I explained you and explained in my PFIC videos also. PFIC gains under section 1291 are taxed at the highest ordinary income rate plus an interest charge calculated from the purchase year forward. The effective burden can be dramatically higher than expected. Next is accuracy penalty. If you substantially understate your income, which means by more than 5,000 or 10% of the tax, whichever is greater, at 20% accuracy penalty applies to the understatement. And if the IRS finds that it is fraudulent, the penalty is 75%. Sometimes clients come to our team, and they ask, claim this deduction, that deduction. Then they ask for receipts or something. They say, no, you claim it. We will see when the IRS notice comes. What you will see? You may not be there in the US tomorrow, but we are here since last 22 years. तुम चले जाओगे, हम यहीं रहेंगे. The preparer is also liable. Some people start tax forms. A note to you, as a teacher, don't claim fraudulent deductions just to get client some more refund. जो आप $100,000 आप फीस ले रहे हो क्लाइंट से, that can cost client his immigration, his dream. I don't know if you have ever gone to a US consulate also, some of you who are doing this business. कैसे लाइन में ठहरना पड़ता है. कभी कभी तो दे वेरी रूड. कितना झेला है इन लोगों ने यूएस में रहने के लिए. बहुत खोया है इन्होंने. तुम्हारे फालतू के $100,000 की फीस के लिए क्लाइंट को ट्रबल मत करना. डोंट लुक फॉर एनी शॉर्ट टर्म गेन्स. बिजनेस ऊपर नीचे होता रहता है. कंप्लेंट्स आते हैं, एस्केलेशंस आते हैं. दैट्स फाइन. क्लाइंट विल अंडरस्टैंड यू and explain the client. Greed is not good. Don't entertain such kind of clients. They are ignorant. Next, statute of limitations warning. Okay. See, the standard IRS audit window is 3 years from filing. 3 years from filing. But if you omit more than 25% of gross income, it extends to 6 years. थोड़े क्लाइंट सोचेंगे, नंदा जी, आई नो स्टैच्यूट ऑफ लिमिटेशन इज ओनली 3 years. मुझे खुद नहीं पता कब आईआरएस आके नॉक करेगा. आई मीन किसी को भी नहीं पता. For F bar violations, the statute is 6 years. And for fraudulent returns, there is no statute of limitations at all. And here is something significant to the Indian community. See, tax compliance issues can affect your immigration status. Significant unpaid tax liabilities or fraud convictions can affect green card applications and even naturalization proceedings also. I'm not scaring you. This is a common situation, but it is a real one. Some clients, they feel they are saving money by claiming some false deductions. मत करिएगा ऐसे. जो भी है liability देखते हैं. We will try to plan the taxes in most efficient way. अगर कुछ गलती भी करना चाहते हो, जान लो उसका consequence क्या है. Just don't go merely by some random statements. I don't want to humiliate anybody or any small time practitioners, but know what will happen. हार्ट स्ट्रोक आया है, नहीं मैं रात में भी दबा के बिरयानी खाऊंगा, दारू पीऊंगा, स्मोकिंग करूंगा, एक्सरसाइज नहीं करूंगा, जंक खाऊंगा, ठीक से नहीं सोऊंगा, क्या होगा? मरोगे. जल्दी जाओगे. नो द कॉन्सिक्वेंस. नहीं, आई जस्ट टेक अ शॉर्ट पैग. ओके, कर लेता हूँ सुबह उठ के. अगर मैंने रात को हैवी खा लिया तो फिर नेक्स्ट दिन शाम को खाऊंगा. You have some healthy discipline, okay. Occasionally, okay. Right? Same thing applies here also. I don't know. I love you so much. That's why, I'm just talking to you all these things. Through the planning process, many of our clients discover that they need more than just a strategy conversation. They need implementation support. We will talk about all these things. Maybe I'm coming to over 2 hours. Probably I'll take a separate video on case studies also. The kind of queries that I get from clients. As an extension of this video. I didn't expect that it will go for over 2 hours, but I'm sure you can see the effort that I'm putting here in educating you. And if this influenced you to at least plan your taxes yourself, husband and wife sit together. Just बैठ के review your iLead. You really don't need us also. आपका इनकम कितना है, लाइबिलिटीज कितने हैं, एक्सपेंसेस क्या है, एसेट्स क्या है, ड्रीम्स क्या है. 6 महीने में एक बार महीना महीना बजट बनाओ. I mean, our parents used to do that, right? Most of our parents used to do that. And in fact, they used to write all in that chota notebook and all. My father used to write like that. And my mother, she used to handle family when my father was diagnosed with dementia. Now my wife handles our finances. Don't feel insecure, sharing your finances with your women. They can be better CFOs. Probably, the best CFO of your home. As man, I'm just telling you. बैठो, बच्चों को भी educate करो. Because kids, they feel, Daddy, I need this, we'll go that vacation, this vacation. Tell them. But if we incorporate a business, I'm working on that. The iPad that you're asking, the iMac that you're asking, we can claim it as a business deduction. I'm just waiting for the business entity setup. This uncle is helping me form the business entity. It'll be done, in like 2-3 weeks, and we will buy that next month better. That will come as a deduction too. Your child should appreciate that. Teach them. Chote chote padao. Rich dad, poor dad. Yeah? Robert Kiyosaki said this. We'll talk about this, PFIC cleanup and compliance, LLC, SCOR, bookkeeping, payroll. If you're returning to India also, you need planning. See, now you have only 2 choices as we close, okay? Option 1, do nothing. Close this window, go back to your day. And next April 15th, you pay whatever IRS determines. No strategy, no optimization, no control. You accept overpayment as a cost of inaction. 2, plan like a CEO. Take control. Know your numbers. Execute strategies while the window is open. Pay only what you legally owe, not a dollar more. What does that look like? You book a session with us, we go through your complete situation, we identify your specific opportunities, we build you a written plan, you execute before June 30. And next April, instead of a surprise, you have a projection and you know exactly what is coming. And one of those 2 options keeps you in control and one of them does not. Which one do you want to choose? Let me know. All the details are given in the description, in the YouTube description link. I encourage you to please go through that. In case you have any questions, please do write to me. I'll be happy to help you. But make sure that you work on this. You work on this. Yeah. I will talk to you soon. I will talk to you soon. You worked hard, for every dollar you earned. You went through the H1B lottery, some of you. You sat in the traffic. You stayed late on video calls with teams across time zones. You navigated a foreign country, a foreign tax system, a foreign way of life, and you built something. You deserve to keep more of what you built. You deserve to keep more of what you built. Legally, confidently, completely. Tax filing documents what has happened, but tax planning decides what will happen. And the decision about what happens starts not in December, not in March. It starts today. Every day of delay closes options. Every month without a plan is the month the IRS keeps its advantage over you. Let's change that, starting today. Book your iPlan session. Just costs you some $60, 60 minutes with me. Or you cannot afford, at least get a tax planning estimate for 2026. Just costs you half of that. Upload your current pay stubs and last year tax return. The team will calculate your 2026 projected tax liability so you know exactly where you stand. But I very strongly encourage you, to get a full iLead review, personal strategy for phase 1. 6 months action plan, penalty prevention guidance. You have the link in the description. Select the services that you want or email asknanda@ileadtax.com. Team will be more than happy to help you. The deadline is June 30, 2026, and after this date, a significant portion of your 2026 planning window closes permanently. Thank you so much. Thank you so much for spending this time with me today. If this was valuable, please share it with your colleagues on H1B, with your spouse, with your friend, in your company, to your payroll department. Ask them to circulate this. इसमें कुछ पैसा नहीं है. With anyone who earns well and has not yet discovered, the difference between filing and planning. Tax planning is not a luxury. For high earners and cross-border taxpayers, it is a necessity. So, go, plan, save, and I will see you soon in our next iPlan Tax Talks. Yeah, take care. Love you all.